Good afternoon, ladies and gentlemen. Thank you for inviting me today. It's a great pleasure to be among such distinguished speakers to discuss and assess the cumulative impact of measures taken and the right policy mix for thriving European capital markets. I would like to start with a general comment. We are living in exceptional times with disrupting political events like the Brexit, a lack of growth, the unprecedented low interest rate environment. And I think in such a situation, it's all too easy to get into a gloomy mood and only see negative developments. And I mean, if you look outside today, and I had to basically run through the rain to get here, that doesn't help either or do the trick there. But nevertheless, I would like us at the beginning of this speech to really take a different perspective. And in line with what Olivier just said, I think it is crucial that we recognize the progress made in the EU regarding financial markets regulation and supervision over the last decade. If you look at, for example, the Giovannini barriers, firstly identified 2001, I think most of them we have been capable of overcoming through market-driven solutions as well as regulatory solutions, and that's just Target 2 securities and CSDR. And I think, and I'll not repeat that, we have had just, I think, a great overview by Olivier what has been achieved on the 40 plus files in the regulatory environment. So, in spite of the achieved progress, I still think we have the tendency to complain about inefficient structures and complex interdependencies. And of course, we need to further improve and overcome any unintended consequences by the interplay of regulatory files. And this is what we've just been heard. And I'll skip actually a few comments on the call for evidence because I don't want you to get repeated information here. But I think we need to be fair here. And I think given the huge overthrow of the regulatory framework subsequent to the financial crisis, it is only natural that there have been quite a few responses and quite a few inconsistencies and gaps identified following the call for evidence. So I would like to take the opportunity to take two observations, and I think there are two poles to it that we can look at. I think, on the one hand, we recently had the opportunity to have a real-life stress test of our own regulatory and supervisory framework. And I'm happy to say, or glad to say, that what we saw was that it was this framework that proved, in the event of crisis, to create reliable markets and ensure market integrity. And of course, I'm referring to the historic Brexit vote here. And I had been during that day, on the 24th of June, a part of an internal expert team at Deutsche Börse Group. We were basically monitoring and analyzing in real time our markets. And what I could see was, ultimately, throughout the whole day, that what we all have been collectively achieved worked pretty well during that day. And what we saw was multiple times trading volumes, we saw incredible volatility, we saw huge margin calls. But what we also saw was that market participants, the industry, were capable to handle such a historic event. And I think that's good news. And if you just want to boil it down to one figure, global stock markets lost around $2 trillion that day. And that's even worse than the Black Monday that we had in the late 1980s. But still, and I think that's due to the hard work post-crisis regulation that we have done, that we were capable to achieve that. And the second observation that I made during that day was we actually have pretty good communication channels between the industry, the market participants, us, financial market infrastructure providers, but also national supervisors and European supervisors through the whole day. And we started, I have to say, really early on in the morning when the news became clear, aligning across markets. And we didn't see any intervention by supervisors. They didn't seem to deem it necessary to do that, and they proved to be right. So, from a political perspective, June 24 was devastating. If you look at it from a purely operational perspective, that was a truly successful day for all of us. So, while the increased resilience of our financial system after the crisis is to be considered good news, on the other hand, there are a lot of concerns and worries given recent political developments. And I referred to the Brexit vote earlier, but it was the result of the US presidential elections in the past week. There was another disruptive vote challenging our perception of politics, which I think should certainly also lead us to reflect on our institutional approach and setup. While I'm a firm believer of economic and financial integration, and while I do take the view that we need further harmonization and convergence, recent elections on both sides of the Atlantic tend to achieve the opposite, spurring fragmentation and irrationality. You know I'm German, and with a view to the upcoming elections in Austria, France, and Germany, there are a lot of concerns how populism and nationalism can be contained to maintain open and liberal societies. And I think after the US election, as much as after the Brexit vote, what we see is a frantic surge to explain why populism and dividing campaigns proved to be so successful. I think that's really the key question that we're posing ourselves right now. And I think while there may be a temptation to follow the populist playbook with catchy slogans and promise of easy solutions, I'm personally convinced that we will be only able to fight back this development if we manage to improve the electorate's living conditions substantially, and not just short term, but mid and long term. Having said that, I think the populist vote is a symptom of economic grievance, and coming back to the financial services perspective now, it has indeed been difficult for the financial services industry to deliver for the citizens, especially in the low interest rate environment. So in light of this, and I think Olivier has said something along those lines, it is really important that we switch our mindset from post-crisis regulation to growth-driven regulation in the future. And this is, of course, easier said than done. And we all know that the Juncker Commission, with its jobs and growth agenda, actually tried from the outset to achieve that goal. However, growth initiatives like the Capital Markets Union take too long to get traction. And from a capital markets perspective, it is still unfortunate to see that we still have a long way to go as far as consistency and clear red line regulation are concerned. So politicians and regulators expect, and they rightly do so, capital markets to step up their game and make an even stronger contribution to society by providing alternative funding sources that facilitate access and that can ultimately foster growth and prosperity at the same time. However, we can observe that capital markets are still constantly under heavy pressure to adapt their business models by facing serious challenges from regulation. And I was happy to hear that Olivier just said that we are looking at proportionality regimes and that there will be files basically coming from the feedback of the call for evidence looking at these topics. So it is against this background that I think it's not surprising that we see Europe lacking significantly behind when we're looking at the global level. And if you just look at a few figures there, if you take the daily equity trading volume, in Europe we have around 50 billion euros. In the US we have 160 billion. In China, 155 and growing. And I think it is also well established by now that SMEs, for example, receive 5 times the amount of funding from capital markets in the US compared to the EU. So that basically describes the not so perfect starting point that we're looking at. So I believe in Europe we're seriously at a crossroad, and we should definitely go beyond political propaganda and really look at empirical evidence, what we can do to achieve this. And let me reassure you, I think it is upon us all, to pave the way for a sustainable future for future generations. That's our task here. So, coming back to the beginning of my speech, we have indeed made significant and impressive progress since the financial crisis. The legislative framework has proven to be fit for purpose. However, recent developments give a new urgency to the need to carefully analyze the cumulative effects. And if there's one lesson from the last weeks, it is that global uncertainty in a political dimension is the new normal for us, and that Europe should not rely on external growth impulses, but need to stand united to develop its own strengths. In a time when it's completely unclear how the relationship with the US might change, and I think this morning's messages that Mary Jo White will step down as an SEC commissioner tells us where we are probably going. And at the same time, when we look at Asian markets and they are struggling to deliver the growth rates that we have all taken collectively for granted, it might be more sensible to reduce dependency in the macroeconomic context and ensure that the EU will be a leading, globally competitive jurisdiction on its own. Thank you.